What if I told you that you could have extra 2k a year just from your investments alone, your 50k portfolio? Sounds too good to be true? As a matter of fact, you can easily achieve this by doing REIT investing. So in this video, I'll show you 8 steps I take by analyzing REITs to find out good ones that can consistently give me a steady stream of increasing and stable dividends year after year. But before we do that, what are REITs all about? So REITs, or real estate investment trusts, are companies that own physical properties in their portfolio. These properties can range from things like shopping malls, office buildings, hospitals, warehouses, and even hotels. Thereafter, they will earn a rental income from their tenants and clients. At the very end, REITs will distribute 90% of their net income generated from their businesses to investors, or aka unit holders, to avoid any additional corporate tax on their business earnings. So this is why you can see that with a good REIT, you can consistently earn a stable stream of dividend income. So now let's move on to our first step in looking at a REIT. So that is to look at property portfolio. So this encompasses 2 points: what properties a REIT invests in and where they invest in. So on the first part of what properties they invest in, is basically look at what the REIT is all about. Do they invest in shopping malls, or do they invest in warehouses, hospitals, etc.? So by knowing what they invest in, you can actually know what are the potential headwinds and tailwinds of the REIT in the near future. So moving on to where the REIT invests in, is basically the countries that the REIT has buildings in. So for example, if you look at CapitaLand Ascendas REIT, you can see their properties in Singapore, US, UK, Europe, Australia, with the majority of their properties in Singapore. So by knowing where the REIT invests in, you can know what is the concentration risk of the REIT and whether there is any potential impact to the REIT growth prospects. So that is step number 1. Moving on to step 2, which is the financial numbers of the REIT itself. So for this, I'll look at 3 specific information. Number 1, the gross revenue. Number 2, the net property income. And number 3, the distributable income. So let's start with the gross revenue. So gross revenue for a REIT most of the time comprises mainly of the rental income from tenants or clients. However, there could be additional streams of income from parking. Most of the time, this is a very small portion of the total gross revenue. So moving on to net property income, this is basically taking gross revenue and deducting any property related operating expenses, which can include things like utilities, waste disposal services, or other miscellaneous stuff that is linked to operating the property itself. So last but not least, we have distributable income. This is basically the cash portion of the income statement for the REIT, which also translates to the amount of dividends the REIT is giving out to its unit holders. So for a good REIT, you're looking at these 3 numbers increasing year after year. So if you have all 3 increasing, it basically means that the REIT is, number 1, bringing in additional rental income year on year. Number 2, this additional income is able to offset any potential rise in property related operating expenses. And finally, number 3, the REIT is able to generate more dividends year on year for its unit holders. Now moving on to step number 3, which is look at the REIT's returns to unit holders. So again, for this, we're looking at 3 separate financial measurements: the net asset value, distributions per unit, and adjusted funds from operations per unit. Let's start with net asset value first, or NAV for short. So this is basically the REIT's real value after accounting for all its assets and liabilities. So moving on to distributions per unit, or DPU for short. This is basically the amount of dividends that the REIT gives to its unit holders. So by having both an increasing NAV and DPU basically means you're holding a REIT that's appreciating in value while also giving out more dividends year on year. Another thing to note is that with an increasing DPU and NAV, it also means that the REIT is also growing sustainably and also in the interest of unit holders. So moving on to adjusted funds from operations, or AFFO per short. You derive this value by taking the REIT's net cash generated from operations and deducting it with its capex related costs. Do note that for AFFO per unit, you're using regular capex costs instead of one-off capex costs. So by having an AFFO that is increasing in value, it basically means that the REIT is generating more cash from its daily operations. So the last thing to look out for is sustainability of the REIT's dividends. So you get this by taking the DPU and dividing it by the AFFO per unit. If it exceeds 100%, it basically means that the REIT's dividends is not sustained by its daily operations. However, this could be due to significant capex related costs or other related expenses. So do look into the cash flow statements and the income statements to see why it's not able to sustain its DPU with its AFFO per unit. So moving on to step 4, which is to look at the financial health of the REIT itself. So like all physical property investment, REITs are also dependent on debt for both its daily operations and also for the REIT to grow sustainably for the long term. In terms of debt management of the REIT, I look at a few common metrics. So for example, the first one would be interest coverage ratio, or ICR for short. So interest coverage ratio basically tells you how many years the REIT can sustain its current interest payments. So for example, if the REIT has an ICR of 2.5 times, it just means that it can sustain its current interest payments for 2.5 years. Generally for REITs, I prefer REITs with ICR of at least 4 times. So moving on to other debt metrics, the other thing that pops out is the REIT's average weighted debt cost. So for this number, the lower the number, the better it is. So it means that the REIT does not have to pay that much for its interest payments. So another thing to look out for is the REIT's debt maturity profile. This tells you how soon the REIT has to refinance its debt and whether they've got any near-term debt refinancing concerns. So this also ties into the term called debt tenure. If you see the average number of years the REIT has for its debt maturity, the longer the tenure means that the REIT debt is more spread out over the next few years. So a high or low debt tenure could be a good or bad thing depending on interest rate environment. If it's a low interest rate environment currently, having more debt to refinance could be a good thing because the REIT can lock in a low debt cost for the foreseeable future. So now the last thing regarding the debt of a REIT is their aggregate leverage percentage. So currently, it's a regulatory limit of 50% set by MAS on REITs. So this means that total property portfolio value is 1 billion. The REIT's debt can only be 500 million. So generally, you do not want REITs to be very close to this 50% limit because there is not much room for them to maneuver in terms of future crises or future growth plans. So moving on to step 5, which is all about occupancy and leases. So this is quite straightforward. Basically, you want REITs to have a high occupancy rate because that means that the REIT is gaining rental income from tenants. If you see a REIT that has a declining occupancy rate, it's a worrying sign for 2 reasons. Number 1, it shows that the REIT is not able to attract prospective clients or tenants. And number 2, it also means that the current tenants or clients are not re-signing their lease renewals with the REIT. So for this profile, you can look into how long the current leases are with the tenants. So for this, you look into the weighted average lease expiry or short form WALE of the REIT. So this number shows you on average how long the leases are in nature. So the shorter the number of years, it means that more portion of the leases are of a short-term nature. A high WALE or low WALE is both a good and bad thing. So for example, for low WALE, although tenants have to re-sign their lease renewals more regularly, it could mean higher rental income as the REIT can negotiate for higher rentals for the new leases. On the other hand, a long WALE means that there's more stability in the REIT's earnings. However, it also means that there's lesser room for high rental income growth. Nevertheless, normally for long WALEs, there are rental escalations set into these leases. For example, for Parkway Life REIT, there is a certain escalation based on the CPI that will be tagged to the rental income annually. So the last thing for occupancy and tenants is that you can look into this term called tenant retention. So basically, this means when it comes to renewal time, how many of the current tenants actually re-sign their new lease with the REIT. So a bonus tip on REIT occupancy is the home ground advantage. So what does this mean is that basically if you invest in REITs with local assets, you can actually go down to the asset itself to see how attractive the asset is. As an example, let's look at GEM, which is a shopping mall in the western region of Singapore. So for shopping malls, their most important aspect to attract potential tenants is the shopper traffic of the mall itself. For most malls, the heaviest footfall can be found in their food and beverages outlets. So for GEM, this is predominantly at the basement 1 level. As you can see, the crowd density for basement 1 is actually quite healthy, although it was not very crowded. However, in GEM's fairness, this video was taken during a weekday. There was not a public holiday, nor was it a school holiday. So I think for that, their crowd density is actually quite acceptable. So as a comparison, let's compare this to level 1 of GEM, where most of the retail outlets and fashion outlets are at. As you can see, there's a stark difference between the crowd density for both basement 1 and level 1. So besides shopper traffic, another thing to look out for in the mall is the tenant mix of the mall itself, where they have huge anchor tenants to attract shoppers to the mall. So anchor tenants in this sense refers to big brands, either in the fashion industry, food and beverages, entertainment, lifestyle, electronics, and also brands that covers our day-to-day grocery shopping. So if a mall has a healthy mix of such tenants, and also healthy levels of shopper traffic, it can be deemed to be attractive to prospective tenants. We're now moving on to step number 6, So for this step is all about the tenant's relation to the REIT's rental income. So for this, I look at two things. Number one, the top 10 tenants contribution and also the rental reversion. So for the top 10 tenants contribution, you're looking at any significant contributor to the REIT's rental income. So normally, we do not want such a huge concentration risk for the REIT because let's say this tenant goes bankrupt or face financial concerns or issues, there could be a potentially huge impact on the REIT's rental income. So on the second portion of rental reversion, this shows you for the tenants that sign a new lease upon their renewal, the amount of rental escalation as compared to the previous lease that they had. So generally, there will be a positive rental reversion. However, let's say if you consistently see a negative rental reversion, it could actually be a cause of concern because sooner or later, the REIT will definitely see a decrease in its overall rental income as compared to previous years or previous quarters. So now on to step number 7, which is the growth prospects of the REIT itself. So for growth prospects, I'll look at 3 main things: potential tailwinds and headwinds for the REIT, the REIT's mandate, and also the management team of the REIT itself. So let's start with potential headwinds and tailwinds about the REIT. So this is linked to the sector which the REIT has exposure to. So for example, let's say you invest in CapitaLand Ascendas REIT. It has exposure to the science, engineering and electronics sector. So you can see what are the potential headwinds and tailwinds of these sectors and see how it can affect the REIT's future earnings. Now moving on to the REIT's mandate. This is basically the growth plans of the REIT. So let's say the REIT has a global mandate. You could expect it to invest in overseas markets. So let's say if a REIT mandate is to stay locally in Singapore, then you will know that most likely not be any future plans for the REIT to actually expand overseas. So moving on to the management team. So this is quite crucial to the REIT because it impacts the acquisitions and growth of the REIT itself. So let's say if the management team is successful in executing its growth strategies, it's able to grow the REIT sustainably in unitholders' interests, then I think that's a good management team. On the flip side, if there's a management team that is pursuing growth in a non-sustainable way, or it also have a strategy to improve the REIT's earnings, I think that could be a potential red flag. So of course, with assessing a management team, there has to be some years for them to actually let their plans run and see how successful their strategy to achieve grow the REIT is. Adding on to management team, we also look at the strength of the sponsor itself. So most REITs will have a sponsor that have links to the REIT manager. For example, let's say you're looking at CapitaLand Ascendas REIT. Their sponsor is CapitaLand. So based on this, you can see what's the reputation of the sponsor itself, whether they have expertise and credibility, the sectors they are in, or the type of properties they actually hand over to the REIT itself. So another point on sponsors is to see that whether the sponsor itself has a pipeline of potential acquisitions for the REIT. For example, let's say Keppel DC REIT, they have a pipeline of potential acquisitions from their sponsor in relation to data center assets. So this can tell you that there's a plan for the REIT to grow should they need to tap on their sponsors' properties. So now on to the last step, which is valuation. So in terms of REIT valuation, I normally look at 3 measurements. Number 1 is price to book ratio, its current dividend yield, and also what is the REIT's price movement. So for price to book ratio, it's basically taking the current market price and dividing it by net asset value. So to see whether it's undervalued, overvalued, or rightly valued, you compare this ratio to its past 5 years historical ratio. To look at historical ratio, normally I use this website called Morningstar. You just search in any REIT you want, say for example Keppel DC REIT, and then it will churn out data about the REIT. You can go to this column called valuation to see what is the 5-year average PB ratio. By looking at the historical PB ratio, you can have a rough understanding whether the current market price of the REIT itself is it rightly valued or not. So moving on to dividend yield. So let's say if the current dividend yield is only slightly above the risk-free rate, then you may not want to invest in a particular REIT because the risk of you taking up that investment does not really make sense if the return itself is not significantly higher than what risk-free investments can give you. So the last thing to look at is the price movement of the REIT itself. So this one is quite straightforward. You just jot down what is the resistance and support level of the REIT. So you want to buy into the REIT where it's close to its support level with the appropriate dividend yield. So yes, those are the 8 steps I follow when it comes to analyzing REITs to find REITs that can generate a consistent and increasing stream of dividends year after year. Hopefully you found it useful, and if you have any questions about REIT investing, let me know in the comments below. I'll try to answer them as much as possible. As always, till the next video, see you all, goodbye.